This lecture starts our examination of derivative securities. First, we'll answer the question, what are they? To do this, we'll look at two main types of derivatives: option contracts called puts and calls. In subsequent lectures, we'll examine two other issues. What can you do with them? That is, how can you use them as part of a successful investment strategy? We'll also look at pricing. What's a good price? For pricing, we'll look at two techniques for pricing: the binomial model and the famous Black-Scholes formula. So let's start with, what are they? Many have claimed that they're evil. For example, Warren Buffett once described them as weapons of mass financial destruction. And Frank Portnoy, director of the University of San Diego Center for Corporate and Securities Law, referring to the financial crisis in 2008, stated, "The mania, panic, and crash had many causes. But if you're looking for a single word to use in laying blame for the recent financial catastrophe, there's only one choice: derivatives." Before we begin to examine derivatives in detail, I should mention that I personally don't think that derivatives are evil or good. As is true of most things in our nuanced and complex world, derivatives have both good and bad aspects. Furthermore, similar to the saying that guns don't kill people, people kill people using guns, derivatives are not intrinsically bad, but they do have some features that can be dangerous if they're not well understood. We'll examine some of these features. In addition, options, a kind of derivative security, are everywhere. You really need to know what they are, how others use them, and how you can use them to your advantage, either as an investor or just as somebody active in modern society. Okay, so let's turn back to the question of what are they? Derivative securities come in many forms. For example, there are futures, there are options, there are things called swaps, and there are even options on swaps called swaptions. At the most basic level, a derivative security is a contract that specifies payouts contingent on or derived from the values of other securities or goods. That is the sense in which they are derivative securities. The types of other securities can be equity, fixed income or bonds, commodities like gold or soybeans, and currency like the Japanese yen. To give you a clear idea how derivatives work, we're going to focus on one type of derivative security called an option. Once you understand options, you can understand the basics of most other derivative securities that exist. Futures become actually particularly very easy to understand once you understand options. There are two types of option contracts: put options and call options, or simply puts and calls. As with any financial contract, with puts and calls, there are always two parties involved. One party is the buyer, while the other is the seller. The seller is sometimes referred to as the writer of the contract. The one who sells a put or a call, they write the contract. When a buyer buys a contract, he or she pays for the option to require the seller to do a particular thing as specified in the contract at some future date. The buyer has an option in the sense that he or she does not have to require the seller to do that particular thing. Rather, the buyer has the option to ignore the contract and rip it up and throw it away if he or she wants to. In contrast, the seller of the option is obligated to satisfy the buyer if the buyer chooses to exercise their option in the future. That is, the seller must honor whatever the buyer wants, even if the buyer wants to ignore the contract. Thus, the options are one-sided commitment. With options, there are many different words or phrases used to describe or denote the same thing. Option professionals often refer to the buyer as being long or having a long position, while the seller is short or has a short position. That is, since the seller is obligated to make good on a promise in the future, the seller is short that obligation. Also, sometimes we refer to the buyer as the holder of the option. The difference between a put option and a call option is with respect to the specific action the buyer has the option to take in the future. To make this less abstract, let's look at the details of a call. Once you get the idea of the call, you'll naturally get the put. A call contract gives the buyer of the call option the option not the obligation, to buy a pre-specified security in the future for a pre-specified price. That is, the future action in this case is buy security X for price Y at date Z. The call option gives its owner the right to call in or buy some security in the future. The owner of the option doesn't have to if they don't want to, but they can if they do. But the seller must honor the wishes of the holder of the option. There are 3 important items call contracts must specify. 1. Which security can be called in the future? 2. At what price can it be bought for? And then 3. When can it be called in? The answer to the question, which security can be called in the future, the contract specifies the security that the option is written on. For example, a call option can be written on a stock in IBM. The security that the option is written on is also referred to as the underlying security or the underlying asset. That is the asset whose value the option is derived from. Underlying assets can be things like equity, like IBM, bonds, like a treasury bond, currency like the yen, commodities like live cattle, indices such as the S&P 500, and other derivative contracts such as futures. I will denote the value or the price of the underlying at time t by S sub t. Although S sub t is typically used to indicate this stock price, always remember that the option may be written on other things other than stocks. To answer the question, at what price can the security be bought for, the call contract specifies something called the exercise price. This is the price that the holder of the call has to pay for the security, say IBM, if he or she chooses to exercise the option. The exercise price is also sometimes called the strike price. Sometimes I will denote the strike price or the exercise price by an X. Finally, to answer the question, when can it be called in, the contract specifies the expiration date for the option. In this regard, there are multiple types of options. European options are those that can be exercised only on the expiration date. American options can be exercised anytime before or on the expiration date. Since the island of Bermuda is close to America, but has European influences, Bermudan options specify a subset of discrete dates when the option can be exercised prior to expiration. That is, Bermudan options, like Bermuda, are somewhere between an American and a European option. You can see the variety of options and future contracts by going to the website for the CME Group, the publicly traded firm that resulted from the merger of the Chicago Mercantile Exchange, the CME, and the Chicago Board of Trade, the CBOT, in 2007, resulting in the world's largest exchange for futures and options. Just click on the Products and Trading tab on the main page at cmegroup.com to see the exchange-traded contracts. This link will also tell you all of the details of each of the option contracts. Okay, now let's work through some specific examples for a call. For concreteness, let's say that you are the buyer of the call that I wrote. Let the call be written on a common stock, say in McDonald's. Right now, the price of a common share of McDonald's is about $100. Just to keep the numbers easy, let's say it's exactly $100. Currently, there are standardized contracts with strike prices ranging from $75 to $115. Let's say the exercise price on the call you and I have transacted in is $100. When the exercise price is the same as the current price of the underlying security, the option is said to be at the money. The set of standardized contracts also vary by expiration date. Expiration dates are usually on the third Friday of every month, ranging from 1 month out to many years out. Let's say that the expiration date for the call that you bought from me is for 3 months from now. Let's say that that's June 21st. So I wrote and you bought a call on McDonald's with an exercise price of $100 and an expiration date 3 months in June 21st. Note that there are 2 transactions involved in this case. The transaction of the option and the possible future transaction on McDonald's stock. The price of the possible transaction in McDonald's stock is pinned down by the contract at $100. The price of the option, however, is determined by supply and demand, not for the stock, but for the option. So even though the current price of McDonald's is $100 and the exercise price of the call is $100, the market price of the call option is probably around $1. Again, just to keep things simple, let's say it's exactly $1. Finally, let's say that the call is a European call. So if you want to exercise it, you're going to have to wait until June 21st. Okay, now let's turn the clock ahead. It's now 3 months hence, and the price of McDonald's has gone up to $105. Since you hold the option to call, and now is the expiration date, you have the option to buy McDonald's from me for a strike price of $100. Do you want to? Yes. If you exercise, you will get to pay $100 for something that's worth $105 in the market. So you should exercise. Pay $100, get a share of McDonald's, then turn around and sell that share in the market for $105 and pocket the $5 difference between the exercise price and the market price of McDonald's at expiration. This is a case where the option is in the money because the price of McDonald's is above the strike price. Now, since you paid $1 for the option initially, your profit is going to be $4. But what happens if the price of McDonald's falls to $95 at expiration? What would you do then? If you exercise, you'd have to pay $100 for something worth only $95. Why would you do that? Recall that you have the option to buy at $100, not the obligation. If you don't want to buy, you don't have to. In this case, you would simply let your option expire unexercised. You would just rip it up and throw it away. In this case, the option is out of the money. It is often useful to depict the payoffs of the option as a function of the strike price, X, and the price of the underlying S sub cap T at the expiration date, cap T. As will be obvious in a minute, these diagrams are often referred to as hockey stick diagrams. A payoff diagram depicts the payoff per share of the underlying that a person receives at expiration date as a function of the price of the underlying on that expiration date. For example, a call option with a strike price of 100, what we would see here would be a plot of the payoff of the price if the price of the underlying turns out to be something like 90, at 95, 100, 105. So what we would see here is we would have essentially a graph that along the horizontal axis are all the different prices that could occur in the market at the expiration date. On the vertical axis, we're going to have how much money the holder of the option is going to get in the event that they have the security. Notice if the strike price is 100 and the price falls below 100, then the person's not going to exercise their option. And so the payoff is essentially going to be completely flat at 0 in that case. But if the price turns out to be above 100 on the expiration date, then the person's going to exercise their call option and they're going to start to make money. For every dollar the price is above the strike price, they're going to make $1 in payoff. So what this plot looks like is essentially, it looks like a hockey stick. When the price is low, less than 100, it's completely flat. When the price is higher, above 100, we have a line that emanates from 100 up with a slope of 1. Now, by the way, the payoff diagram does not consider what you paid for the option initially. A profit diagram does consider the initial cost of the option by shifting down the graphs by the amount of the initial cost. While it is traditional to do this, I want you to realize that it's not quite accurate in that the cost was incurred at the time that you bought it, which is much prior to expiration. Thus, the traditional profit diagram ignores the time value of money of the cost associated with buying the option in the first place. Let's go back to the previous example. What happens to me, the writer of the call? If the price of McDonald's at expiration is 105, then you will exercise. I will have to sell you something worth 105 for $100. I lose $5. Given the initial price at the option on net, you gained $4 and I lost $4. That is, your gain is my loss. We just went through the payoff diagram and the profit diagram for a long position in a call. What about the payoff diagram for a short position? In this case, it is simply the mirror image of the payoff on the long position. Okay, again, from my perspective, what if the price of McDonald's had fallen to 95 instead? You don't exercise, and I don't have to do anything. You're out the $1 from buying the call, and I get to keep the $1 from the sale. In this case, my gain is your loss. This is an important feature of options. They are what economists call a zero-sum game. In fact, you can see by superimposing the profit diagram for a long position on a profit diagram for a short position, if you just add these things up because they're mirror images, what you end up getting by adding them vertically is a complete flat line. It's zero. What that means is whatever the person that has the long position gets, the person that has the short position loses. And whoever has the short position, if they get anything, the person with the long position would lose. So in total, everyone will get nothing. By the way, is there really any reason for us to actually transact in the shares? If I didn't have a share of McDonald's to sell you, I would have to go into the market to buy a share for $105, just to turn around and sell it to you for $100. And then you would probably go back into the market and sell that just so you could get the $5 gain. So why don't we just skip all this buying and selling of the shares, and at expiration, I just give you the $5. This is called cash settlement. Most options are cash settled. Before moving on to puts, let's review the set of concepts we've discussed so far. Call options allow the holder to call in or buy a specific security, the security the option is written on or the underlying asset, for a specific price, the exercise price, on or before a specific date, the expiration date. For every option transaction, one person is long the option, while the other person, the seller, is short the obligation to do whatever the option holder wants to do. Call options are a zero-sum game. The amount one person gains is the amount that the other person loses. And then rather than actually transact in the underlying security, most options are cash settled. Okay, now that we know something about calls, let's turn to puts. Rather than giving the holder of the option to buy, a put gives the holder the option to sell a specific security at a specific price on or before a specific date. As with a call, the put also has a strike price and an expiration date, and puts can be either American or European. Unlike with calls, the holder of a put benefits when the value of the underlying security falls below the strike price. That is, the put holder can force the writer to buy the underlying security for more than it's actually worth. If the underlying security value is higher than the strike price at expiration, then the put holder would choose not to sell the security for that lower strike price. In that case, the holder lets the put expire unexercised. As I stated earlier, options are everywhere. For example, if you have a mortgage, you actually have two options, a prepayment option and a default option. The prepayment option is an American option that lets the borrower swap the promised stream of monthly payments for the amount of the remaining principal, the present value of the amount that is left to be paid. This allows the borrower to move, say because they get a new job someplace or they want to relocate to a better house. It also allows the borrower to act strategically and refinance if that's to their benefit. If interest rates fall, then the borrower can borrow the remaining principal by making smaller monthly payments. So what they would do is they would borrow that money and use the borrowed money to exercise their prepayment option. Now, if interest rates rise, you're not going to refinance, and you'll continue to have the low rate that you locked in initially with the mortgage. A mortgage borrower also has a default option. If the value of the house drops below the remaining principal owed, then the borrower has the option to put the house for the amount that is owed. That is, the borrower can get out from under the mortgage contract simply by giving the house to the lender. This is just like a put option, where the borrower forces the lender to buy the house for the strike price equal to the remaining principal. As we will quantify in subsequent lectures, options are valuable. People just don't hand them out for free. So since the mortgage borrower receives two options with their loan, the price of the loan, the interest rate charged, reflects the cost of the lender providing the borrower with these two options. Thus, mortgage rates would be lower if the law did not give borrowers the option to prepay or to default. Of course, this is only a problem if, given the choice, borrowers would voluntarily give up these options in order to get lower rates. Also, leading up to the financial crisis of 2008, many new mortgages were originated in which the borrowers put very little, if any, money down. In these cases, the loan-to-value ratios, the ratio of the amount borrowed to the value of the property, were very close to 1. So for many mortgages, the principal was very close to the value of the house purchased. As a result, in many cases, it only took a small decline in the value of the home to make the default option be in the money. Another feature of options relevant to the financial crisis is the difference between exchange-traded options and those traded over-the-counter. Standardized option contracts are traded at exchanges, like the CME. Non-standardized options are negotiated and traded amongst people in what is referred to as the over-the-counter market. The over-the-counter markets are not as transparent as those that are traded on the exchanges. While the exchanges have procedures to guard against the seller of the options reneging on their obligation, there's no such safeguards that exist in over-the-counter markets. Rather, the over-the-counter markets rely on relationships and trust built over repeated transactions. Moreover, there was no central clearing that kept track of the size of positions individuals or institutions had. Without this knowledge, there is something called counterparty risk. This is the risk that the trading parties that have a certain obligation will not make good on that obligation. Options were also thought to be a big contributor to the financial crisis in 2008. Aside from the default options that mortgage borrowers exercised, there were other derivative securities called credit default swaps, or CDS, written on another kind of derivative security called a collateralized debt obligation, or CDO. CDOs would take the payments from a pool of mortgages. They would then use the mortgages as collateral to sell bonds. Some of the bonds sold would be very short-term in nature, so most of the cash coming from the mortgage payments would be used to pay those bonds off first. Other bonds were much longer term in nature. By the way, these different types of bonds that are sold that are backed by the payments from mortgages, these are called tranches. Okay, so CDOs are actually fairly complex because whether a longer-term tranche gets any payments or not depends completely on what the default experience is on the pool of the underlying collateral, in this case mortgages. And the defaults on mortgages depend upon what? The strike prices on the default options in the mortgages that are in the pool. And that in turn depends upon what? The loan-to-value ratio. By the way, the complexity of CDOs prompted Nobel laureate Paul Krugman in a July 2, 2007 New York Times article titled Just Say AAA to offer the following. What do you get when you cross a mafia don with a bond salesman? A dealer in collateralized debt obligations, CDOs. Someone that makes you an offer you don't understand. A credit default swap, or CDS, is an option to swap a defaulted bond for its face value. This is a put option. It allows the buyer of the option to insure against default. So how does a credit default swap work? The buyer of the instrument acquires protection from the seller against a default by a particular company or a particular bond. We'll call that the reference entity. So for example, a buyer of CDS is going to pay a premium given the amount of the value of the bond. That premium is typically a number of basis points. So for example, you might pay 90 basis points for 100 million for 5-year protection against a default on a bond issued by, say, Company X. The premium, by the way, is referred to as the credit default spread. It's paid for the life of the contract or up until there is a default. If there is a default, the buyer has the right to sell the bond for its face value, right? So the owner of the credit default swap has the right to put into the seller of the credit default's hands a bond that has defaulted for what? To get its face value. So remember, what happens when there's a default? We look back before, and what happens when there is a default? You end up getting what? The recovery rate. The recovery rate ends up being a fraction of its face value. So in the event of a default, the bond is worth less than its face value, and if you have a credit default swap as protection, as an owner of that credit default swap, what you want to do is you want to exercise your put option and put the defaulted bond into the hands of the person that sold you that credit default swap for a strike price of the face value. Now, prior to the financial crisis, many mortgages were bundled together to create CDOs. Then what would happen is those institutions, many banks and pension funds, they would buy the CDOs, and they would also buy credit protection in the form of CDS, credit default swaps. But because CDS was not transparent, there was a surprise when it turns out that AIG, who had sold sizable amounts of credit default swaps, experienced such significant losses that if they were to have failed, there is no way they would have been able to pay off on all of the credit default swaps that they sold. So in that case, what ends up happening, right, is people had bought a lot of credit protection in the form of credit default swaps from AIG, but if AIG had actually paid off on all of these credit default swaps, essentially insurance against default, then AIG would have failed. So what happens when you get insurance from a company, for an insurance company that essentially fails? You really don't have any insurance. If it weren't for the U.S. government bailing out AIG, then it would have been the case that most of the people that owned credit default swaps that they bought from AIG, they also would have gone under as well. Because what they were trying to do was protect themselves against losses. Those losses would have hurt them significantly without that insurance. When the company that insures you against defaults, right, you have no insurance. So in order to prevent a systematic failure, the U.S. government bailed out the insurer in this case, so that others would essentially stay insured. Okay, so in this lecture, we have looked at what a derivative security is. We've examined two prevalent examples, puts and calls. We've also talked about how you would optimally exercise a put or a call. If you own a call and the price ends up at expiration above its strike price, then you exercise it and you get the difference between the price in the market at that time for the underlying and the strike price. If the price of the underlying at that time at expiration is below the strike price, then you do not exercise it. You let it go away. You just let it disappear unexercised. In contrast, for a put option, what happens if the strike price is if the price at expiration is above the strike price, then there's no reason for you to sell something for the strike price that's worth more than that. So if you own the put, you let it expire unexercised. But if the price is below the strike price at expiration, then what you're going to do is you're going to exercise it. You're going to sell something worth less than the strike price for the strike price and make that difference. Okay, so the other things that we've done in this lecture is we've looked at what a payoff or a profit diagram would look like. We've also understood that This is a zero-sum game. By looking at what long positions plus short positions look like, we're going to end up getting zero payoffs. We've also examined how the lack of transparency in over-the-counter credit default transactions contributed to instability during the financial crisis in 2008. In subsequent lectures, we're going to see how to use these as part of an investment strategy. We're also going to figure out how to price them.